Welcome to the Everything Apartments podcast. I'm your host, Eric Christopher. I'm president of WSC Realty Advisors here in Long Beach, California, where I'm an apartment broker, owner, and property manager for the last 15 years. This podcast covers all aspects of multifamily investments, from buying and financing properties, which is where we're going to be at today. We also cover day-to-day operations, management, and into reinvestment strategies to help you increase your net worth. We have a great show with a great guest today, so let's get right into it. I don't think it's a stretch to say that 90+% of apartment purchases are financed, and certainly the refinance market has been a fabulous vehicle to build wealth. So accessing the debt markets is always a regular travel if you're actively investing in multifamily. But like almost everything in business, there's some pitfalls, and we're going to talk about some of those today and how to do a loan the right way and what the market's looking like. So this topic of debt is big enough to do that, drill down into it. You may be in the middle of a loan right now, or maybe it's been a while, or maybe you're just getting started, sticking your foot in the water about investing in multifamily. So no matter what, it really is a good idea to keep up on where the current debt markets are. That's obviously a moving ball. Economic tides and currents. We've seen, for example, COVID, but then we've seen cycles and we've seen black swan events that severely change that debt market very soon. And if you're getting ready to pull a transaction, you may want to be out ahead of that a little. So today we have with us Jeff Monahan, who's a 30-year veteran in the multifamily lending field. Jeff's been focused on this endeavor with Chase Bank for over 25 years, and he's telling you, we'll get to that in a minute, but it goes all the way back in the rings in the tree in the Great Western to Washington Mutual, then to Chase. And really one of the exciting parts about having Jeff here today is his team, which is right here in Long Beach, is consistently one of the top producing multifamily teams for JP Morgan Chase. I mean, that's a pretty big deal, as you can imagine. And then at the same time, Jeff couples his experience in multifamily lending with that of an apartment owner himself, with a portfolio of properties here in Long Beach. And in his free time, Jeff's a boater, a pilot, and just a general outdoor enthusiast. Hey, Jeff, good morning. Welcome. And we're really glad you could join us today. How are you?
I'm well, thank you, Eric. That's a wonderful introduction and some sage advice in just what you just said. And I love, I have to touch on the getting ahead of it is so important today. If you're really looking at buying another property, even refinancing, to the extent that you can kind of keep your finger on the pulse of where financing is, it's just a great asset. If there's mortgage brokers out there, if there's people that specialize in just doing debt for clients, and those are their owners, kind of understanding that underwriting is dynamic, and it's kind of, it's not something that you can say, hey, where were you were 6 months ago, you were here, where are you today? It doesn't change that much. And it's not to insinuate that Chase's program is all over the board. It's not. It's a consistent product line, but the underwriting philosophy can evolve, does change with the times. And it's important for everybody to maybe just understand that a little bit. And I find that the most effective mortgage brokers in the business really know my business fairly well. They don't ignore it and just say, hey, I got a client, bought a property, hey, go get the financing somewhere. Those that can kind of get ahead of the financing, understand the financing from the brokerage standpoint, from the sales brokerage standpoint, really are much more effective brokers as well, to the extent that we have some brokers that are out there.
Absolutely. And you hit the nail right on the head. Is that's a constantly moving ball over a set of months. And the thing that I've recognized in my career working with principals is it's not something they think about that much until it's like right in front of them. I need to get this loan. I got, they may be sort of skewed in their mind on what a proper down payment is. And we won't get into this yet, but we will. It's like everyone wants those value add transactions that they can create an upside for themselves. But a lot of times they don't realize that it takes a larger down payment to do that. So it's a big enough mechanism, I just said in the intro, that anybody who's active, well, probably already is kind of in tune with debt, but it's not bad for everybody to just kind of take a quick pulse on that every 3 or 4 or 6 months and decide what it means to them. So let me ask you a question, just
sure.
real quick summary. I have been a little bit out of this loop, which is why part of the reason I'm glad to have you here personally. Right
Yep.
now, just give me a couple yardstick metrics on if I'm going to buy a multifamily building. Let's say I have 500 grand or something to place. What kind of interest rate structure am I going to find? What kind of LTV, DCR? Just give me a quick little, boom, boom, boom on that that world right now. What am I going to be up
Absolutely.
against?
I'm gonna make a little distinction here because I think it's important that we do. This is 5 units and above. So for
Absolutely.
those, potential owners, entry level buyers that may be looking up to 4 units, that's a different world in financing. So, and just, I'll give you the highlight of that, not to focus too much on it, because I don't want to bore people that already know this. But up to 4 units, you're a single family loan for the most part. Okay. We recognize that maybe you're buying a triplex, a duplex, a fourplex, but that's a different set of underwriting. And what they're going to look for is going to be, they're going to look for your tax returns. They're going to look for your W-2, how much money do you make? And then they're going to find out whether or not you can make the payment, and they do their own underwriting based upon your income, not the income of the property. It's almost not relevant to them. They're going to look at a loan to value. They're going to look at how much can you support. Well, you can get 10% down, 5% down, 20% down on some, fourplex, keeping in mind that sometimes the values of those are already a little bit higher just on a per unit basis. But nonetheless, you're going to be able to get higher leverage on 4 units and below, but for a different set of criteria. Once we go into the 5 units and above, and we'll call that the commercial sector. It's kind of a blend between commercial, residential, but it's a commercial loan. Now we're looking at the income of the property, and secondary and tertiary forms of repayment will be the borrower's income. Tertiary will be the property value itself. But we're really looking to the income of the property to drive loan dollars. And that's why today, because of cap rates being low, that people are sometimes surprised when you say, hey, what do I need down to buy a property here in Belmont Shore or somewhere in Long Beach? And it can be different areas, but the down payment typically, and I'm just going to say, is about 35 to 40% down. And if you really get into low cap rate areas, you can be below 50% and less. And that's only because the income is driving the loan dollars. People are paying for that cash flow. And right now, when multifamily is, a favored place to invest, there's demand for it. So what does demand do? It just raises the price up. But the income didn't go up, but the price went up. So what's that differential? We have a certain loan amount. I don't care, what the value is so much as what is the income produced? Because the idea is that income repays debt service. It's not loan to value. And I know, over the years, the last thing you want to say in a committee meeting is, well, look at the loan to value. It's so low. No, income pays debt service. When the income goes away, people struggle with payments. So our
that was
objective
something
is
that
to
took
make
me a
sure.
minute
Yeah,
to figure out is, because the LTV is kind of the thing that you hear people referring to more often than the DCR. And for newer
they
listeners,
do.
the DCR is basically the number of times your net income covers that debt service. Now, from the last loan I did,
Absolutely right. Yeah,
I think it was wanting to be right about 120, 125. Does that sound about right?
that's about right. And I can say this, prior to COVID, that was probably about 115. Okay. But after COVID and where we're at right now, we're about 120, 125, but generally speaking, 120 on a debt service coverage. Yes.
Okay.
Just to
So,
give to throw some numbers, and loan to value becomes kind of, we're income and debt service constrained. We're not loan to value constrained. We'll go up to 75% if you just want to throw a number out there for loan to value. Do I see a 75% loan to value deal very often? I really don't. I haven't seen one in years. And that goes for a lot of markets across the board.
we
And
did
it's
see
not
those,
because
we had a good run there where I remember doing, for a couple of years during this uptrend, and don't challenge me on exactly the year it was, because we've been in this uptrend since 2000. You could argue 2011 and for sure 2012.
correct.
But
Yes.
we were I remember, doesn't seem that long ago, but it probably is because I'm old, but the 25% down vis 75% LTV was there for a while. And then as that uptrend just continued to prevail, then all of a sudden you're like, okay, one day you woke up and it was 65% LTV. But if I'm understanding you right, the DCR drives that more than the LTV does
Yeah.
for itself.
So you have a pent up demand in terms of value, but the rents don't go up quite proportionally all the time. All right. So
Hmm.
the values are probably gone up, percentage wise greater than the underlying income. Therefore, what happens is relative to the value, it looks like the loan is less, but it's still only being underwritten by the income that's produced on that property. So it's always important. Another thing, and we could spend plenty of time on this, but little things I
Yeah.
want people to understand. It's very important that when you decide you want to refinance a property for max dollars, make sure your rents are up to market as much as you can. Now we're a little bit inhibited today because you can't do it overnight, because
Hmm.
we do have some rent control to deal with in a lot of cities now that we didn't used to have. So it's a little tougher to get it up to speed. So it's very important for borrowers, and I would say this, and most people probably know this: stay up with your rent increases to the extent that the property can absorb them. Because when you get behind, your value of your property is definitely impacted by that. And at least the demand for the property. You might say, hey, the property, comps with this one down the street at, 300,000 a unit. Well, the rents up on that one were much higher than where your rents are. So you're going to get beat up because it's going to
Hmm.
take a while for someone to catch up. They're going to have to move out. You're going to have to, you're limited right now to about 7%, 5.7% rent increases in some of our local areas, for example. So important to make that every year on that, anniversary, at least evaluate your property. Can you, will absorb a bit of a rent increase and, keep yourself, about market as much as you can.
You could take that
Um,
into a different place and say, have a plan. And the financing side of this, really, it never goes away. You might want to be keeping your mind around the financing side perpetually. For example, okay, I want to refinance or I want a 1031 exchange or whatever I want to do. Let's say 2 years from now. Well, there's stuff you got to start doing now, like getting those rents up and tightening up the expenses. And so but what I've found, and probably like you too, is you talk to somebody that they've got a plan and it's here now. We're going to do this and that, and they just don't have the context around A, what they should have been doing, or B, what they're going to meet up with when they try to do it. Let me just segue into this.
sure. Yeah.
In my career, when the markets have really got hot, I think I've been through like, two or three really hot markets where the cap rates compress and all kind of where we are now. And I remember in some of my transactions where we had a problem with appraisals versus the contract values. Do you see that in the market right now? Is there a problem meeting appraisal on these transactions, or is it's working out okay for that?
No, it's working out okay. And where you find that disconnect sometimes, Eric, is when you have a changing market and you have your appraising staff that's using historical data.
Mm-hmm.
So on an uptrend, they're using stuff that might be, a little behind. But I can tell you the staff here makes a concerted effort to, when we're in a changing market, they're trying to get ahead of it. An example would be in a rising market, they're looking now we recognize we're using historical data. Does anybody have anything that's currently in escrow recently closed? And I'll oftentimes turn to a sales broker that's brought me a deal and say, hey, do what you can right now to find your own comp, okay, that hasn't hit the records, that hasn't closed, and it's not being seen by our appraising staff. Tell me what you have in escrow. What's it in escrow for? Let's, let them know where that is. So, and I can say this, our appraising staff is really trying to do as good a job as they can. When I say good a job, I'll define that as being as accurate as they can as to where the market is and what the valuations are. Now, that being said, let's go back to the appraisal and the loan to value versus really what drives the loan dollars in my case, which is actually the income on the property. So I'm more content and more concerned that they are focusing on where the rents are, and hopefully they're at market. and recognizing where market is.
Mhm.
So that's the most important thing that, again, is driving the loan dollars. I'm not overly concerned of where the appraisal value comes in. I'm really not. There is a concern from a standpoint that we do give some pricing discounts. I don't want to get into that. That's an individual deal for
Right.
loan to value. So for low loan to value, we're going to get a little better rate than we are if we're a little higher loan to value. So, and when we're down on the borderline, hey, we got a 60% break, 60% LTV, and the king came at 62. Am I going to go raise the guy's rate over 62% loan to value? It's a general rule, no. Okay, so we're trying to get as close as we can. This is not a perfect science in terms of appraisal, but we've got a good staff that works well with the appraising staff that we have here. When I say good staff, my own staff basically has been working with these people for a long time, and we have an in-house appraising staff, which doesn't mean that they're somehow I can guide them, but
Right.
they're there and available, and they spend a lot of time and have a lot of resources with this company to give as accurate a number as they possibly can, and that's what I'm concerned with. That's part of why I really have been here as long as I have been, is because this company is constantly trying to better themselves. They're not sitting back on their laurels, even though they've been the top, multifamily lender for years. They recognize that there's always someone that, hey, wants to take a pot shot at you. We want to be ahead of that. And I can
Well,
go
for
on and on
sure. And
about what
the
you're doing there, but
difference,
that's not the purpose of this. Yeah.
well, you guys have a great working rapport together, and that's going to open the can on a question I'll ask you in a minute. So
Sure. Yeah.
let's push that one down the road for a second.
You bet.
A lot of people that may listen to this, like I mentioned earlier, they might not have done a loan in a while. Maybe they inherited a building for cash. That's kind of been the extent of their real
Yes.
estate. They may say, hey, you know what? I watched a seminar or saw somebody that talked about this 1031 exchange and how I could refinance or whatever.
Yes.
So let's just go dance down the road of I have $500,000 I want to
Yep.
place,
Okay.
and I want to
Yeah.
buy some units with that money.
Mm-hmm.
Is it good to, because I've known in my career I've seen a lot of these little lender letters that seem to work or matter to anybody. Is it good to contact you to size me up before I go shopping, or is it better to send you over a couple transactions that I would consider striking on to like?
Well, I think that what you just said is basically the same thing, if I'm understanding correctly, and very important. So what I tell people, if it's a first time purchase, you're going to go out in the brokerage world and you're going to look at it. Someone's going to throw a couple deals at you. It could be 6 unit, 7 unit, 10 unit, whatever it is. And what I would encourage you to do, and this is the best way to learn how we underwrite and how we think. I've got a setup, Jeff. I'm thinking about buying this property. Maybe it's, can I afford it? What kind of loan can I get? Send me the setup. That is a 5 to 10 minute quick underwriting, to give you an idea of where you would land on this. And every deal that you think you're considering, make a point to send it over. Is it self-serving that I would like to be involved in it? Absolutely. But at this point in our careers, and my team as well, we're here to really educate people out there to, even if they don't use me, I want them to understand how this works, because it works that way with our competitors. I don't think they do nearly as good a job. I don't think they're as rated competitive, but that's, you expect me to say that. But I'm really here to educate people on how this is underwritten. And the more they learn about that, the more effective they are in their own investment, making their own investment work for them. And also they know what to expect when they get themselves under contract. The last thing you want to do is get yourself under contract with the idea that I've got my 25% down, and next thing they find out is that, whoa, wait a minute, I need way more than this to do this transaction. It's a beautiful property in Belmont Shore, and gee whiz, I thought that someone would be 75% loan to value because the area is so great. Well, unfortunately, it's just the opposite of that, because the cap rates are so low in those areas. Consequently, you're probably putting more down. And I don't want to see someone get wrapped up in a purchase contract that they can't get out of and potentially lose money.
Yeah,
Because they just go, oh, I didn't know I couldn't do this. Well, that's a tough way to learn that lesson. So just right up front, real quick, throw it at me, throw me the setup, and be happy to give them an idea of where we would land on the letter of intent. Right?
Okay, so we're taking this down the road here. Now I've done, well, funny sidebar note, I did a loan with Jeff here, disclaimer, or complete transparency, I guess you'd say, I did a loan with his team before I knew him, and we ran into each other at the gym, and we figured out who each other's were. I said, "Oh, you did a loan for me. It's working out great. Glad to finally meet you." So my question is, because I've done a loan or two with a broker friend of
Uh-huh.
mine some years back. Tell me what you tell people when you want to do a piece of business with me, and I say, "Oh, I've got a broker and he's going to shop me into whatever." I mean, give me the dynamic between an institution like Chase versus using an apartment loan broker. What's my
Well,
difference?
if we're going to talk about probably the low hanging fruit in addressing that is, um, number one, it's going to be cheaper to come directly to me. There's plenty of brokers that will come to me, but I'm going to give them a par deal. Well, the par deal is they're going to have to add a fee onto that.
Mm-hmm.
And consequently, if you came directly to me, I'm going to give you the same par deal and you won't have the fee. So you're going to have 0 points. So from a standpoint of just pure economics, it's probably cheaper to come to Chase directly. I'm not saying that the mortgage brokerage community doesn't have a place, because they certainly do. And a lot of them do come to me. And a lot of borrowers just feel that the service they get from a mortgage broker, maybe they come over. The point is, I'll come over to your house and package a deal for you as well. But they might have a relationship with someone that they want to, keep them in the loop. And I have no problem with it. We deal with a lot of mortgage brokers. And it's a very successful relationship. But keep in mind, if you want to come direct, you certainly can. But if you have an intermediary in there that you feel like you'd like for him to go out and shop for you, you can certainly do it. You might find something that better fits you. And I'm the first one to say, show me what you have. And I said to someone today, hey, you've got a deal. That rate wise looked very attractive, unknown bank to me, but nonetheless looked attractive. I told him, I said, hey, that might work better off for you. Well, he backed up. He goes, well, I'm not sure I really want to go there, Jeff. Don't push me away. I said, I'm not. I can certainly give you a quote from a portfolio standpoint and also from a Fannie Mae standpoint, because we do have Fannie Mae in-house now as a DUS lender, full DUS lender. So we've really kind of touched on all the bases for, borrower needs. So again, is a mortgage, to answer your question simply, is there a value add? Yes, there is, in terms of just them maybe putting a package together, possibly for you if you have a relationship with them. I don't want to shut them down because I do a lot of business with them. But
you're going to pay a fee
you're going to pay a fee for it. That's all I'm going to say. You're going to pay for their service. I think that, and a lot of them, want to come to me.
Sounds reasonable. Okay, so
oftentimes they'll come around and go, they get a Chase quote from the same guy, so.
Yeah, right. So if you really want to have that person inserted into your equation, if they're bringing in your mind that much extra value, you're just going to pay for it.
That's correct. Yeah. And I would say that if you've got something in an outlying area, you've got something in the middle of Victorville, and you're looking for financing, you might bring in a mortgage broker to find out if he can find somebody who'll do it in Victorville. Yeah. We're not overly active in the city of Victorville necessarily. It's no done a diss on Victorville. We just don't have the expertise there right now.
Okay. But so I decided I'm ready to move forward with you. What I'm looking for now is kind of, where are my pitfalls? Like, everybody glosses over the process. They sort of make this assumption they can get a loan when they put their mind onto it. And what maybe the question is in your travels with the whole multifamily investor base that you've been working with forever, what's the biggest pitfall, or what could, you mentioned rent increases before to get the max loan dollars, but what should other things should borrowers be thinking about when they approach you? Like, hey, I want to get this deal.
Yeah.
Where do they go wrong? What can't they bring you? What kills the deal for them?
Good question. We don't have a lot of things that, that necessarily, I'm not just saying this just to say this. There's not a lot that necessarily falls apart because a borrower isn't on top of it. I would say if there's a credit history that I need to know, let me know, and I'll bring a couple other things. So that's one thing. So if we've had some issues credit wise, I want to know that right up front. I don't want to discover that, well beyond the application process. And the application is going to ask that. So that's one thing. Another thing today, let's make this a little more timely. And that is today, what's most important from a refinance perspective and also from a purchase perspective. You might have an occupancy that a 95% occupied building today. How many of those tenants are paying? And this is a COVID related thing that we really have to kind of stay on top of because it's going to be asked. We can have 95% occupied buildings with 80% of the tenants paying, 20% maybe not. And that's important to know because that will change our underwriting and our approach to loan dollars today. We're trying to accommodate that as best we can and not hit the deal too hard with it. But the reality is we're underwriting existing income, period. So we want to make sure that we have a story behind those tenants that are paying or not, or those that are not paying and what their payment plan is. If they've got a payment plan and they've been, paying on it for the last 2 or 3 months, that's pretty solid. And we also recognize this is not forever. More than likely, this is not forever. This is a temporary blip if we're talking about COVID-related changes in underwriting. And we've even come off recently, during COVID, we were asking for 12 months of payment in escrow. You could use that payment in escrow to make your payment. That we've eased off of that now as we're starting to come out of this, and as the unemployment numbers start to rise, and we find that we're not finding people with new non-pays in their property. Most of them is just working through those that maybe are a bit behind now.
Yep.
So that's important. What are the collections from a sales standpoint? When you're buying a property, know that. From a refinance perspective, know be upfront with, hey, these are the number of people that are paying. We expect them to continue to pay in the future. Here's where we're at today. So I don't want to belabor that point, but I think the point's made.
No doubt. Now that's an added wrinkle that we wouldn't have had to thought about.
That is correct.
Yeah. And who knows, if you took that thought a little further, seem to see this eviction moratorium getting kicked down the road. Now it's June 30. I'm firmly believing it'll be September 30. I heard another apartment annexation webinar last week that they're like, oh no, it's going to be January. And for those people that are, sitting in there, now we could talk about rent relief, which is happening right now, but just from the underwriting aspect, you're like, hey, we still can't get rid of anybody who isn't paying us. It's gotta, like you're just alluding to, make that underwriting a little tougher.
Yeah, and hence, where we might have been 115 debt service coverage, we're 120 now. Mm-hmm. And I could say that might adjust a little bit with a property that's challenged. I encourage people that if it's a little bit challenged in terms of collections, let's wait a month or two. If you think it's going to be better in a month or two and you're trying to maximize the dollars on a cash out, it behooves you to maybe just wait, remedy some of those problems, get people current as much as you can, then come and refinance with me because it'll help us a little bit. Because what might have been, 120 might be 125 or 130, effectively just given the inherent risk on a property that has tenants not paying.
That's a great point, because I've got one right now that I would think about refinancing, but I've got one tenant that's way back and I've been working on her for cash for keys. It's like, look,
I know.
We're going to have to evict you as soon as we can, which
Correct.
I'm throwing at her as June 30th. Probably not, but it's like, I've got this offer for you today, but the relevancy, that the motivation for us to keep that offer in place for you is going to expire pretty quick because June 30th will be here, hypothetically. And so there, I guess for the listeners out there, there's always something you can do. You can work that, you can get rent relief. And I don't know if the banks would underwrite that rent relief into their loan, looking at the timeline that's going to expire sooner than later for evictions. Who knows how long the courts are going to get back up, but at some point we get to a bigger normal than we're still in now.
Yeah, if we're looking at rent relief, and we are more than happy to help anyone if in fact they need that. Okay. I don't know if rent relief, but I'm talking about mortgage relief. We're more than happy to help them through that. That's one aspect of our business. But if they're going to refinance, then we're going to ask that rent relief be brought current.
Hmm.
That mortgage relief be brought current before we
Yeah.
target another refinance. And I don't know if I got off subject there, but yeah.
No, it's all piecing together like a puzzle. But I guess, the idea for the listeners is like, what can we do ahead of time? And we've brought a few of those things in. Give yourself a window where you can make some positive adjustments to your equation, the building, the tenants, or whatever else that you can
Yeah.
iron out before you approach the debt market. And it could be a large positive difference in what you end up with than if you just kind of twiddled your thumbs and said, "Hey, Jeff, I don't just do it." And it goes with a lot of things we do in real estate. It's like, think ahead, come up with a plan. Hopefully you don't put yourself in a time crunch because you need to do something today, which is like never a strong position to be in, really.
Yeah.
But pave the road ahead of you to do a refinance or a purchase. And if I guess the point that Jeff's making that I'm taking out of this is doing some of these small things can really benefit you when you get to the finish line of that loan.
Yeah. And be upfront with, some of the stuff that might be a little tough to discuss. Let me know, because I might have options and have a suggestion to you. You're talking to me, you're talking to the bank at the same time, but saying, hey, here's what I've got. Give me, I want to look behind the curtain, and you can feel free to discuss that with me, because what you don't want to do is get down the road and have someone else, an appraiser, discover something that really wasn't, disclosed to me up front. And this doesn't happen very often. It really doesn't, because I think I'm pretty open with people to let them know, let me know what you have, and let's work through that. Because, what 30 years experience tends to do is give you, ways of working around. They're workarounds. And it's not that we're deceiving anyone. We're just finding a way of structuring a deal so that it can still get done without surprises. Sometimes surprises actually taint the view and the perception of a borrower or a property, because it wasn't disclosed up front. I would much rather address all this right up front. Say, here's what we've got. Is there a way of structuring this that, will be, works for the bank as well as the borrower? That's really what the objective is.
I think what he's saying is that you can go ugly with him early.
Absolutely.
Right?
Yeah.
Well, all right, let's leave it there, Jeff.
Yeah.
As normal, I always learn something from you when I talk to you about this kind of stuff, and there'd be no doubt that pretty much anybody out there wouldn't feel the same way. And I really appreciate it. I think there's some great knowledge involved with the lending side, and you brought some of that today, so I really appreciate it. And glad you're here today.
Yeah. And if you get any feedback, Eric, let me know, because I'd be more than happy to address this. So it's very relevant. I recognize people's time is valuable, and I don't want to ramble on any of these issues. I really like to hit the things that people will have a question about, and I'd be happy to address those. They can call me at my office anytime. I'm right there in Belmont Shore. Walk in once we get back in the office, but feel free to give us a call. Okay.
Well, absolutely. When I
Yeah.
publish this episode, I'll have your name and contact information in the show notes. So who knows? Obviously he's a wealth of resource of knowledge around this stuff, and works for a great company that's been doing a ton of
No,
multifamily loans for a long time. It's kind of hard to argue with it being a stop in your process of learning and moving forward. So
well,
appreciate your time, Jeff.
absolutely. On
And
behalf of Chase and myself, thank you very much for the time. Okay. I appreciate it.
absolutely. Thanks for joining the Everything Apartments podcast. We'll be back next week with a discussion about apartment sales metrics, which also relate to the debt side. So thank you for joining us. Have a great afternoon.